All right, welcome back, everyone. Today we are diving deep into a really interesting concept that's been kind of floating around the financial world lately. It's called le facteur peur, or in English, the fear factor.
Yeah.
We're taking a look at this financial article that claims this phenomenon is creating some pretty unique investment opportunities, kind of similar to what we saw during that whole COVID-19 crash.
Yeah, it's a pretty intriguing comparison, right? The author actually predicted this current downturn, before going on vacation. And they've laid out a strategic approach to not only surviving this period, but thriving in it.
Oh, wow. That's a pretty bold claim. I'm sure you're wondering, like me, what exactly is driving this whole fear factor thing? Well, the article points to a bunch of different factors, actually. It mentions trade wars, public sector layoffs, persistent inflation, and high interest rates. We'll definitely unpack each of these. But first, I got to ask, I'm curious about this comparison to the COVID-19 crash.
Yeah, sure. It's not really a direct correlation, more like a similarity in market sentiment. Remember all that uncertainty and panic back then? We're kind of seeing echoes of that now, but fueled by a different set of anxieties.
Okay, yeah, that makes sense. So let's break down these fear factors, starting with trade wars. Now, I vaguely remember hearing about tariffs and trade disputes and stuff, but how do they actually contribute to market instability?
Okay, so think of it like this. When governments start throwing tariffs around, it disrupts the flow of goods and services across borders. Businesses face higher costs, which then get passed down to us, the consumers. And this uncertainty about prices and supply chains can really make investors nervous, leading to, you guessed it, market volatility.
Oh, okay, yeah, that makes a lot of sense. And then you have those public sector layoffs. It's always tough to see people lose their jobs. Is there a broader economic impact, though? Like beyond just the individual level?
Absolutely. Public sector layoffs can sometimes signal a strain on government services and resources, which can erode investor confidence, leading to concerns about overall economic stability and growth prospects. It's all kind of a ripple effect. It influences how people perceive the overall health of the economy.
Right, yeah. And of course, who can forget about inflation? We all feel it every time we go to the grocery store.
Exactly. Remember when eggs were like our normal price? I feel like those days are long gone. This constant rise in the price of all the essentials, food, energy, that kind of stuff, it adds to that feeling that things are, maybe spiraling a little out of control, which further fuels that market anxiety.
Yeah, speaking of things potentially spiraling, there's that whole issue of high interest rates. I remember Jerome Powell, the Federal Reserve Chair, he basically said we shouldn't expect those rates to drop anytime soon. So what does that statement actually mean for the market?
Well, higher interest rates mean it's more expensive for businesses to borrow money, which can potentially stifle growth and innovation. And for us regular folks, it impacts everything from mortgages to credit card debt, putting a real strain on household budgets. It's this chain reaction of economic anxiety that can really contribute to market instability.
Right, so it's all connected. So this author saw all these factors brewing, and they made a pretty decisive move, increasing their cash position to 30% before the market even started to dip. Sounds like they were battening down the hatches, preparing for a storm. But what makes them so sure that a downturn is coming?
Okay, so this is where it gets interesting. The author predicts a potential drop of 22% in both the NASDAQ 100 and the S&P 500. They believe this whole fear factor is going to lead to a pretty significant market correction.
Wow, 22%. That's a huge prediction. But here's what I find really intriguing. They aren't just hunkering down, waiting for the market to recover. They're seeing this potential downturn as an opportunity.
Exactly. Instead of panicking, they see this as a chance to buy low and potentially reap big rewards when the market, inevitably rebounds.
Wow, that's a very different perspective.
Yeah.
This is not what we usually hear during, times of market uncertainty. So how do they plan to sift through all the wreckage and find those hidden gems, those stocks poised for strong growth amidst all this fear?
Well, they've developed a very specific set of criteria. For identifying those growth stocks, they're focusing on factors that indicate long-term potential, rather than just those short-term fluctuations.
So it's about looking beyond the immediate fear and focusing on those fundamentals.
Okay, that makes a lot of sense. What are some of the key factors this author considers when evaluating a company's potential for growth?
Well, one of the first things they look at is revenue growth.
Yeah.
Specifically, companies that have a consistent track record of increasing their revenue, ideally between 15 and 20% annually. I say consistent revenue growth. That definitely indicates a healthy business, even in a tough market. But revenue alone doesn't tell the whole story, right? What else is on your checklist?
You're absolutely right. Revenue is important, but it's equally crucial to look at earnings growth. Are these companies actually turning their revenue into profit? The author aims for companies with annual earnings growth between 20 and 25%, which really shows their ability to manage costs effectively and deliver value to shareholders.
So we're talking about companies that are not just growing, but growing profitably. That's a powerful combo, especially when everyone else is, hitting the panic button.
Precisely. Now, another crucial element is historical performance. The author has observed that stocks meeting these revenue and earnings growth criteria, they often see their price increase by 30 to 35% annually.
So we're looking for companies with a proven track record, companies that have, weathered storms before and come out stronger. But what about those stocks that have taken a hit recently? The ones that have, fallen significantly from their highs?
Yeah.
Are they a lost cause or a potential buying opportunity?
That's a great question. And the author actually sees those dips as potential opportunities. They specifically look for stocks that have dropped significantly from their 52-week high, sometimes as much as 60%. This can signal a buying opportunity for savvy investors, the ones who believe in the company's long-term potential.
So it's like bargain hunting, but with a strategic approach.
Yeah.
But how do we know if those fallen stars are actually worth, scooping up? What else are they looking at to assess a company's potential?
Well, they don't just rely on past performance, they dig into analyst forecasts, examining Wall Street projections for earnings per share in 2028. This forward-looking perspective helps assess whether the current dip is a temporary setback or a sign of, deeper trouble.
So we're not just looking at the past. We're trying to get a glimpse into the future, see if those earnings projections align with the growth story we've been piecing together.
Exactly. And it's not just about financial numbers. The author also looks for companies that are making strategic investments in their future, particularly in areas like artificial intelligence and workforce expansion. These investments signal that a company is actively positioning itself for growth and innovation, even amidst market uncertainty.
That makes sense. Companies willing to invest in those cutting-edge areas, they're likely betting on their own long-term success. But we can't forget about the fundamentals. Financial health is still paramount. How does this author assess a company's overall financial stability?
They really emphasize the importance of reviewing balance sheets, cash flow statements, and financial reports. These documents provide a deeper understanding of a company's financial stability and its ability to withstand economic downturns.
It's like a financial health check.
Yeah.
We're making sure these companies are not just growing and innovating, but also managing their money responsibly. Okay, that's a lot of data to go through. How does this author manage to analyze all this information effectively?
Well, this is where things get really fascinating. This author has incorporated artificial intelligence into their analysis process to streamline the research and identify the most promising opportunities.
Hold on, AI in investing. That sounds incredibly futuristic. Can you tell me a bit more about how that works?
Absolutely. They've developed a three-pronged approach using AI to analyze companies. First, they have an AI podcast, which offers a 15-minute deep dive into a single company's financial health and prospects.
Wow, a personalized AI-powered podcast analyzing a company's finances. That's amazing. What about those who prefer to read their analysis, though? Is there something for them, too?
Of course. They also provide a written briefing, which summarizes the key findings of the AI analysis, for those who prefer a quick read. And for those who want to go even deeper into the data, they offer an AI financial analysis tool. This tool provides a comprehensive assessment of a company's financial health by analyzing balance sheets, income statements, cash flow statements, and other key metrics.
It's like having a team of financial analysts at your fingertips, all powered by AI. It really highlights how technology is changing the way we invest. But before we get too lost in the world of AI, let's step back for a second and recap what we've learned about le factor peur, this whole market phenomenon, driven by those fears of trade wars, public sector layoffs, persistent inflation, and high interest rates. It's being compared to that market sentiment we saw during the COVID-19 crash.
Right. And while it's natural to feel apprehensive during times like these, the author's approach is to see this downturn as an opportunity. They've developed a really strategic method for identifying growth stocks, focusing on companies with strong revenue and earnings growth, a solid track record, and a willingness to invest in their future.
And let's not forget their secret weapon. Those AI-powered tools that streamline the research process and provide in-depth analysis. It's all about using data and technology to make those informed decisions. Even when the market feels like a like a roller coaster.
Exactly. It's a fascinating case study in how to navigate uncertainty and turn a potential crisis into a strategic advantage. But at its core, it all comes back to that concept of le facteur peur. It's not about ignoring the fear, but understanding it, dissecting it, and using that knowledge to make smarter choices.
So what does all of this mean for you, our listeners? How can you apply these insights from Le Facteur Pair to your own investment journey?
Well, I think the first takeaway here is that fear is just a natural part of the market cycle. It's not something to, be ashamed of or try to ignore. Instead, as the author suggests, we should view it as a signal to be more discerning, to dig deeper, to really understand the companies we're investing in.
Yeah, you hit the nail on the head. It's about harnessing that fear and turning it into a catalyst for informed decision making.
I love that perspective. So it's not about, blindly buying into the hype or panic selling at the first sign of trouble. It's about becoming informed investors, doing our due diligence, and making decisions based on, solid data and analysis, much like the author's framework. Exactly. Think back to those criteria we discussed earlier: revenue growth, earnings growth, historical performance, analyst forecasts, strategic investments, and financial health. These aren't just, arbitrary metrics. They offer valuable insights into a company's resilience and potential for growth, even during, those turbulent times.
I'm curious though. Let's say you're looking at a company and they meet most of these criteria, but maybe their earnings growth has slowed down a bit recently. Would that be a red flag? Or could there be other, factors at play?
That's a great question. It really highlights the importance of not just looking at the numbers in isolation, but understanding the context behind them. Perhaps the company is investing heavily in research and development, which could temporarily, impact earnings, but ultimately lead to significant innovation and growth down the line. Or maybe there have been, industry-wide challenges that are affecting profitability. It's about looking at the bigger picture and not making those hasty judgments based on just a single data point.
That's a good reminder that investing isn't just about, crunching numbers. It requires critical thinking and a nuanced understanding of all the forces at play.
Absolutely. And let's not forget the power of technology in helping us make sense of all this data. The author's innovative use of AI, particularly those tools they mention, the AI podcast, the written briefing, and the AI financial analysis, those can be incredibly valuable for streamlining research and gaining deeper insights.
I have to admit, I'm still a bit skeptical about AI in investing. It sounds incredibly futuristic. But can we really trust algorithms to make such important financial decisions?
Yeah, that's a valid concern. It's important to remember that AI is a tool. It's not a replacement for human judgment. These tools can analyze huge amounts of data much faster than any human could, identifying patterns and trends that we might miss. But ultimately, it's up to us to interpret those findings, consider the broader context, and make those informed decisions based on, our individual risk tolerance and our investment goals.
So it's about using AI to augment our own knowledge and decision-making abilities, not blindly handing over the reins.
Precisely. Think of it like having a team of expert analysts working for you. They're crunching the numbers and highlighting potential opportunities, but ultimately you're the CEO making the final call.
I like that analogy. It's about leveraging technology to empower us, not replace us. But beyond the tools and the data, this author's approach also highlights the importance of mindset.
Absolutely. Their perspective is all about seeing opportunity, where others see only, fear. It's about having the courage to invest when everyone else is running for the exits, and the patience to ride out the storm and reap the rewards when the market inevitably recovers.
It's a reminder that successful investing is often a long game. It's not about, getting rich quick, but about making those informed decisions, staying disciplined, and having a long-term perspective.
And remember, you don't have to go it alone. There are resources available, from, financial advisors to online communities, to help you navigate the complexities of the market and refine your investment strategy.
Exactly. Don't be afraid to reach out, ask questions,
Yeah.
and learn from others who have, experience in this field. The more you learn, the more confident you'll become in your own investment decisions.
Yeah.
So we've talked about the author's strategy for identifying those growth stocks, their innovative use of AI, and the importance of having that right mindset. But as we wrap up this deep dive into Le Facteur Peur, I want to leave you with a thought-provoking question to ponder. Imagine this. Imagine you have all the information we've discussed today, like right at your fingertips. The author's insights, their criteria for selecting those growth stocks, even access to those AI tools they've developed. How would you use this knowledge to navigate the current market? Like, what step would you take to not only protect your investments, but maybe even capitalize on this whole fear factor thing?
That's the real challenge, isn't it? It's one thing to understand these concepts, in theory, but it's a whole other thing to put them into practice in the real world. You got to take all this information and tailor it to your own situation. Your risk tolerance, your financial goals, your investment timeline.
Right, exactly. This deep dive wasn't about giving you a, one-size-fits-all solution
Hmm.
or telling you exactly which stocks to buy or sell. It was about giving you the knowledge and the tools so you can make those informed decisions that align with your own investment strategy.
Yeah, I think the author's approach is really fascinating, but it's just one perspective. There are tons of other investment strategies out there, each with its own, strengths and weaknesses. The key is to find what works for you, what aligns with your understanding of the market and what you feel comfortable doing.
That's a great point. It's about becoming an active participant in your financial journey, not just blindly following someone else's advice. And I think that's where the real power of this deep dive lies. It's not about telling you what to think, but giving you the tools to think for yourself.
Couldn't have said it better myself. Knowledge is power. And in the world of investing, that power comes from understanding not just the what, but but the why. Why is the market reacting this way? What are the underlying forces driving these trends? What are the potential risks and rewards associated with different investment strategies?
It's about asking those tough questions, challenging assumptions, and developing a deeper understanding of how the financial world really works.
And remember, the learning never stops. The market is constantly evolving, presenting new challenges and opportunities. So stay curious, stay informed, and keep seeking out new knowledge and perspectives.
I love that. Stay curious and keep learning. And don't be afraid to reach out for guidance when you need it. There are so many resources available, from financial advisors to online communities, where you can connect with others, share ideas, and learn from each other's experiences.
Exactly. Investing doesn't have to be a solitary endeavor. Engage with others, ask questions, and be open to different viewpoints.
So as we wrap up this deep dive into Le Factor Per, I want to leave you with a sense of empowerment, not fear. Yes, the market can be volatile and unpredictable, but with knowledge, preparation, and a strategic mindset, you can navigate those uncertainties and potentially even thrive during those times of market turmoil.
Remember, le factor pur is a natural part of the market cycle. It's not something to be feared, but understood. And who knows? By embracing this fear factor and approaching it with a strategic mindset, you might just discover opportunities that others overlook.
So go forth, fellow deep divers, and use this newfound knowledge wisely. We're excited to see what brilliant investment strategies you all come up with. Until next time, stay curious, stay informed, and keep diving deep.